How you doing today? My name's Miles Pitcher. I'm the owner of Superior Lending. I'm a mortgage geek. I love strategizing about mortgages and looking for opportunities that can help save our clients interest, get a lower monthly payment, or just find a better solution for them in mortgages. So today we're talking about the new Biden mortgage rules that have been all over the headlines. I've seen things in there calling it socialism, robbing the rich to help the poor. It's really quite incredible how these headlines have grabbed hold. I want to go through today and really show you some pros and cons to this because there are some silver linings in these mortgage rules. So let's jump into it. All right, some of the headlines that you've seen out there, they're everywhere. So the first thing you need to know about is what a loan level price adjustment is, an LLPA. In short, these are adjustments or fees that apply to a loan based on the risk assessment of the loan. Some of the things that affect a loan level price adjustment would be somebody's credit score, how much down payment they have, are they a first-time home buyer, what is the property type, a condo, single-family home, a multi-unit home, is it going to be owner-occupied or used as an investment property? And then the last one is a debt ratio, meaning how much of a person's income goes towards paying that mortgage and their other monthly obligations. I marked that one because that was going to be coming into effect, but it's been removed, meaning that there will not be an adjuster or a hit, as we call it, for debt ratios anymore. So I want to give you a few things here. So first of all, understand that the Biden changes only affect conventional loans. That means loans that are going to be sold to Freddie Mac and Fannie Mae. VA, FHA, USDA, jumbo loans are unaffected by these changes. Okay. Number two is that the penalty for our lower credit borrowers has been reduced. Does that mean that they will get better rates than a 800 credit score borrower? No, it just means that the penalties in that risk assessment have greatly been reduced. And they combine that with if you're a first-time home buyer, and it's pretty cool for the first-time home buyers. Here's one that people aren't talking about. In the past, if you were 740 or higher on your credit score, that was the maximum benefit you could get. But now they've created some additional credit bands at 760 and 780. So for those clients that truly are 780 plus, 760 plus in their credit scores, they are going to be rewarded for being up there. The other thing people have been talking about is these adjustments. They don't realize that these have been priced in and planned for and put into place for several months now. Why is that? Because these risk assessments are going to be really applied to loans that have closed, that are being bundled up and sold to Freddie and Fannie. And that's when it goes into effect. So May 1st is when those had to be in place. So our loans for the last 2 months have been priced out according to these new loan level price adjustments. Bottom line, a higher credit score still will have a better rate than a low credit score borrower. So you've seen this graph probably floating around social media. It is confusing to people who don't look at this all the time. If you look along the top, it says loan to value. That means how much down payment you have. So a 95% loan to value means you have a 5% equity or down payment. The left-hand column has credit scores. So if you go across to the very top right, it says if you're 780 higher and 5% down payment, there's a hit or an adjustment of 0.125. That is not a 0.125 adjustment to the interest rate. Okay. There are basis points and fees in these loans. So just don't look at that and go, wow, my rate is an eighth worse for having a 780 FICO and a 5% down payment. Don't get confused by that. I want you to be aware also that FHA has recently made some changes in their monthly mortgage insurance premium. They've reduced it. And what this is doing is it's really opening FHA as possibly a better option than conventional. It just depends on the scenario. But these lower credit borrowers, we typically do take to FHA because FHA has fewer loan level price adjustments than conventional does, especially on lower credit borrowers. I want to give you an idea here. So based on all this that we've told you about these adjustments and in there is that as you're going through your loan, you may want to ask your loan officer and say, hey, would I get a better interest rate if I did a 5% down rather than a 20% down loan? And have them look and see, okay? You could get a better interest rate. And that's pretty cool because what you can do with that, and this is a strategy that we've worked with several clients, is your loan amount's going to be a little bit higher now. We close the loan, we do 5% down. I'm able to give the client a better interest rate, and sometimes I'm able to give them a little credit to help with some of their closing costs, okay? They make their first payment, and with that first payment, they add in extra principal at that time of the other 15%. So now they've paid down the loan to the 20% mark, okay? That payment gets processed. They're able then to call up the lender, the servicer on the loan, say, hey, I'd like my PMI removed off the loan. Boom, they take it off. It takes a few weeks. It's a process. Okay. Then they do something that's called the recast. And I'll link to a video on a recast here. But in short, a recast is a way for you to come to the lender and say, I've made a large principal reduction in my loan. I would like you to recalculate or re-amortize my monthly payment. There's usually a small fee that goes with that, $150 to $300, and they'll recalculate your monthly payment based on your new loan balance. It's not a refinance. You don't have to pay all the closing costs again, but it's a great way to get your loan recast or the monthly payment brought down. So there's just an idea for you if you're doing a conventional loan, something for you to talk to your loan officer about, a cool little strategy that may help you get a lower interest rate. It may help you get some credits for your closing costs, and that's all great to benefit you. If you want to reach out to my team or have us look at any scenarios for you, that's how you get a hold of us there. That's my digital business card. Feel free to text us, call us, email us. We're happy to help. We are able to do loans in all 50 states. Have a good one. Thank you.